these money managers start to think like, maybe we need to make some allocations into gold.
Yep.
That could put a tremendous upward pressure on the price. And then all this talk about, these really, really bold predictions that, oh, gold could go to $3,000 an ounce. How about 10,000? How about 20,000? I don't know what the effect of Ukraine's default will be. Default it will. But I think that, it could be one of those things like the subprime where, you had one institution go down and then everything just kind of started coming down like a house of cards.
Okay, guys, we've got Alex Krainer back on the show today. Alex, thanks so much for coming back on for a third time. The hat trick.
Always fun, Danny. Thank you for having me, and warm greetings to all your viewers and listeners.
Yeah, for sure. If you guys are enjoying this content, by the way, I'd like to remind you to hit that subscribe button if you haven't already. It does go a long way, even though it doesn't seem like much. It is a lot. A little bit does go a long way. And we are producing these videos on a daily basis, or just about 5 to 6 times a week now. So you might miss an episode if you don't subscribe and hit that bell notification as well. And with that said, Alex, let's just dive right in. Let's start off macro, and then we can kind of hone in on specific topics. What is kind of like your overview of the global economy, the markets in general, geopolitical, anything you want to talk about from a macro scale?
Yeah, where to begin? It seems to me that we are going back to inflation, which probably isn't going to be a big surprise to anybody. But I think it has very, very significant implications for everything. And so I think it's worth underscoring that there are two types of inflations, right? So you have the inflation that you get when you have economic growth. The credit cycle is up. People are taking out loans, they're starting businesses, they're buying homes and cars and things. And consumer demand, because people, there's high employment, people are kind of feeling prosperous. And so the consumer demand is pushing prices up. So you have this so-called benevolent inflation, which, the monetary authorities aim to run it at 2 to 3% a year. And that kind of keeps up with economic growth. And so people don't necessarily feel like it eats into their lifestyles, into their standard of living. But then you also get inflation from not so benevolent process, which is a debt overhang, when you have too many unpayable debts in the system. And so you have banks which are burdened with bad debts. There's a shortage of collateral. There's not much fuel for the credit impulse to continue going. And so what happens is that the governments or the central banks have a choice. Either they go the way of austerity, they push for lowering spending, paying down the debts, and clearing the debt overhang in this way, or they have to QE, they have to print money in order to backstop the bad debts on their books. And that can take any form, but usually in the West, it takes a form of corporate welfare. Governments end up spending a lot of money to dish it out to the big corporations. Central banks indirectly end up, in the US, this is illegal, but they finagle it and make it legal, issuing money to buy corporate debt, and that way keep the banking system from imploding. And I think that we are there. And then the fact that there's this QE, quantitative easing, and more money being printed out eventually gives rise to inflation, as we saw in 2021 and 2022. Now, inflation has subsided thanks to the Federal Reserve quantitative tightening and unwinding partly their balance sheet. But unfortunately, that tends to create a recession or a depression. So at some point, the Fed's going to have to QE again, and there's some evidence that they're doing it anyway, covertly, because we've seen that during the QE process, the bank balances in the United States, commercial and retail, have shrunk by about 7% from first quarter 2021 until the third quarter 2022. And now, since the beginning of this year, we've seen from Q3 2023 until Q1 2024, the bank deposits have increased by about 1.5% or 2%. Anyway, the annual growth rate is between 2 and 4%, and it will probably continue over the next 2 to 3 years. And so this means that more money is entering into the economy, and that could again ramp up inflation. If we go back to inflations of the 1940s and the 1970s, in each case, we see that inflation has three distinct waves. So it rises, then it goes down almost to normal. Then the second wave is usually, in both cases, it has been the bigger wave of the three. And then it goes back down again. And then there's the third wave. And this process in the 40s and in the 70s has lasted about 10 years. And so far, we have seen only the first wave of inflation. And I think that we're beginning the second one. But the real problem is not just domestic economics. It's also that we might also get the commodity price inflation at the same time. We now see, just today, what are we, 20th of August? Gold is trading at all-time highs. Silver and platinum have also gone up a little bit. Crude oil is not moving quite that much yet. But in general, commodities have had a strong wave up in 21 and 22. They've pulled back since, but that might give rise to the second wave of inflation. And given the geopolitical situation, there's all kinds of developments that could push up the prices of precious metals and energy in particular, but then also ultimately the prices of agricultural commodities. And then we get maybe a perfect storm, an inflation resulting from the debt overhang and from the commodity price push.
Is there precedence for both of those occurring at the same time?
Now you ask me a good question. I don't know, because I think that maybe we would have to go back to the 40s, but I don't exactly know what happened then, or maybe even to 1800s, where you had the Civil War and economic. Yeah, I couldn't answer that question.
Yeah, because one thing is for sure, wars are inflationary, not deflationary, right?
Oh yeah, of course.
And we're in the midst of a war cycle right now, and the chances are, things are going to be inflationary at the very minimum on the supply side. And then you brought up the debt overhang, the sovereign debt crisis as well, and the mixture of the two. I just wonder if that's ever happened at the same time before. Are we kind of like at an intersection between two big cycles, crescendoing right now? But you did mention gold making new all-time highs. Do you see gold as the leading indicator for another spike in commodity prices? In 2020, you kind of saw it happen that way. Gold moved first, and then the commodities came after. But what's interesting is that silver's not chasing it quite yet. Not entirely. It's sitting at around $30 or a little under $30, but it's not making new all-time highs like gold is. So what's your take on what is the gold price signaling? What is it sniffing out in your opinion?
Well, I think it's signaling loss of confidence, but it's at this point, I think it's being led by large accounts and central banks. And I guess that could be the factor that's pushing up the price. I think that the man on the street still doesn't quite understand how mispriced gold is.
Mm-hmm.
I think it's partly cultural because for the last 2 or 3 decades, we've been really brainwashed to think of gold as a barbarous relic, like as a pet rock that doesn't do anything, that's not worth anything, and that's some kind of a quaint museum piece. But we've seen over the last years that many central banks around the world have been adding to their gold reserves, and they have been buying gold,
Mm-hmm.
and that this trend has been accelerating. The cultural aspects, I thought there's a really interesting video that Mark Dice did a few years ago, I think 2 or 3 years ago, and he took a gold eagle, 1 ounce gold eagle coin, and somewhere in California, literally right next to a bullion dealership, he tried to get people to trade him like their t-shirt, their baseball hats, their half empty water bottles for this 1 ounce piece of gold. And not a single one of I think he asked something like 15 or 16 people. Not a single one took him up on it. And I think at the time it was worth 2,300, this ounce of gold. So he was offering people $2,300 for a baseball hat, for a t-shirt, for like a water bottle. And nobody took him up on it, which is kind of a reflection that people simply don't perceive that there's value in gold. But that changes, because if you go back to maybe 2015, 2016, you would have encountered the same disbelief in people if you offer them a Bitcoin. People will say like, what? Bitcoin? What's that? Nobody cared. And I remember, because in the company where I worked, we launched a Bitcoin fund in 2013. And, we were like a regular hedge fund company. And pretty much everybody in the community, in the industry and outside, thought that we were absolutely insane, that we were going to damage our reputation, that we were just being stupid. And Bitcoin at the time was trading at around $300, $400, about there.
Mm-hmm. And
everybody was like, oh yeah, whatever, that's limited supply of nothing, what's the point? You guys are just being silly. And then in 2018, Bitcoin had one of its hockey stick appreciations, and it hit, I think, $18,000 or $19,000 an ounce, a Bitcoin, sorry. And then the phones wouldn't stop ringing. Like the phones were ringing off the hook. Everybody wanted to jump into the Bitcoin fund. So nobody was interested at $400, but everybody was really excited at $19,000, which tells you that, this cultural aspects plays a role. And so I think that gold at the moment is still in that period when people don't quite see it. Now it's at $2,500. Maybe in another few months' time, if it's at $5,000, then everybody's going to want to jump in, and everybody's going to be talking about gold, and everybody's going to be talking about, oh, we need to buy gold, we have to invest in gold. And it's good to keep in mind why we're getting all these hockey stick charts in one market after another, because it really is happening in one market after another. We have something like $220 trillion in the shadow banking system, which means investable liquid assets in hedge funds, endowments, pension funds, bank balances, and all this. So this is not money that's being printed up by the Fed. This is actual money that's globally available for investing. I think that the gold market At current prices, all of it is worth, I think, less than $3 trillion.
I think it's a little north of 10 trillion.
Oh, is that right? Yeah. Okay,
Yeah,
you may be
the
right.
gold
You
market
may be
cap.
right. Yeah.
But anyway, I mean, it takes a lot to move
Okay.
it.
Yeah. Yeah. Okay. I have to. Yeah. But it's anyway. It's puny compared to the shadow banking system.
Mhm.
And so what that tells you that if only just a small fraction of these money managers start to think like, maybe we need to make some allocations into gold,
Yep.
that could put a tremendous upward pressure on the price. And then all this talk about, these really, really bold predictions that, oh, gold could go to $3,000 an ounce. How about 10,000? How about 20,000?
Are you in the market for gold and silver? Then, if so, please consider Miles Franklin. They are my gold and silver dealer of choice. So, not only do they have super competitive prices that you're going to have a really hard time finding elsewhere, but then they also have top notch customer support. I know Andy Schechtman, the owner of Miles Franklin, top notch guy. I wouldn't be recommending them to you if I didn't have faith in their product mode. What you really want to do, however, you want to email them at info@milesfranklin.com, and you want to say that Capital Cosmos sent me in the description line, because when you do that, you can get access to their special pricing sheet. You want to get that special pricing sheet because you're going to get special prices that you won't find on the website itself. So email them at info@milesfranklin.com. Tell them that Capital Cosmos sent you, and you won't be heckled with spam emails, etc. There's no commitment necessary. I promise you that. And with that said, I will let you get back to the video.
We haven't seen the future, but we've seen what Bitcoin did, Nvidia, Tesla, Google, Apple, cocoa prices, cobalt, palladium. It's just one thing after another. People get excited about, and then all of a sudden it goes vertical. And once it goes vertical, there's no telling how high it could go. So I know that's what I see for gold. And then we haven't even touched upon, when we talked about commodities price inflation. One of the things that hasn't budged is oil prices. And right now we have extreme tensions in the Middle East. We have a full 1/3 of United States naval capacity moving into the Middle East. Everybody's expecting that Iran is going to retaliate at some point in some way against Israel for the assassination of Ismail Haniyeh in Tehran on the 1st of August. And well, if that happens, where could oil price go? They go to $150
Especially
a
if they shut
barrel.
off the Strait of Hormuz.
They shut up the Strait of Hormuz. They blow up some pipelines. I mean, a lot of things can happen. A lot of things. And so, it's we're dealing with an extreme high degree of uncertainty, and markets, a lot of them are behaving like it's any day of the week, like it's nothing wrong, nothing's wrong. So I think that the risks are to the upside, and that means inflation, and that means ultimately that the central banks in the Western economies, United States, EU, Britain, Japan, are going to have to print, and they're going to have to print a lot. And that means a lot more inflation.
Why do you think gold appears to be, moving up as a risk asset as opposed to oil? Oil seems to be de-risking right now. It just keeps going down and down. I think it's like $74 right now. Why is gold moving as if there's risk upon the horizon, but oil still hasn't?
Well, I think it's down to large accounts, large investors, and central banks. And so gold is seen, I think, as a safe haven asset, and oil is something that I think most investors are still not used to investing directly. So I think the most investors, if they think of oil, they will invest in BP or ExxonMobil or Royal Dutch Shell or something like this, or oil exploration companies, fracking companies, whatever. They don't necessarily bid up the oil prices themselves. And I think that for the moment, there just isn't a sense of emergency in the oil markets. And there's also at the same time there's a sense that the economies are slipping into a recession. So maybe some market participants think that the demand for oil is going to be going down. And so maybe that's what's keeping the oil prices still a little bit depressed at the moment. But again, this could change any day. And I think that the downside, what are we now? Trading around $80 a barrel. I think that there's relatively limited downside in the short to medium term, but there's a lot more upside because going back to when was it? I think it was 2019 when we had a sudden, unexpected geopolitical event in the Middle East, and that was when the Houthis attacked the Aramco oil production facilities in Abqaiq in Saudi Arabia. And then overnight, so that happened on Friday or Saturday. On Monday, when the markets opened, oil price jumped $12 a barrel. And then by the end of the day, I think it closed $8.5 a barrel up. So that's just one day. And It was just one attack that, it didn't escalate from there. But it tells you the pressure that can suddenly release upon the price of oil if something unexpected happens. So that's the upside risk. It could do $10 a day a barrel in a day. Whereas on the downside, even if people perceive, the demand is going down, blah, 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 all this. Well, we had $120 a barrel 2 years ago. And now we're at 80, so 33% lower now. How much lower can it go? It can halve from here, whatever. But that would be an extreme, let's say if we had a pandemic and there were lockdowns, maybe the oil price could halve. In the ordinary course of business, I would say another $5-6 a barrel. But on the upside, it might be 20, it might be 50, it might be $100 a barrel.
Yeah, so a couple of weeks ago, we saw the yen carry trade unwind. Gold actually held pretty strong while everything else sold off. Do you see that completely over? Are we out of the woods, or is there more trouble ahead, do you think?
For the
yen carry trade.
For the yen carry trade, I don't know. I heard expert opinions on both sides. Yes, it's going to continue. There's going to be, the unwind is going to carry on. I'm not sure. I'm not sure what to think, but historical precedents strongly suggest that regardless of the carry trade, that the Nikkei is going to continue going up higher, and that the Bank of Japan is going to have to continue printing the yen. That's what always happens in these crisis situations, which is why we have so many examples through history of a nation's economy basically disintegrating and the stock markets going vertical.
Mm-hmm.
So famous example was Weimar Republic in Germany in 1921-22. We had in 2008, 2009 Zimbabwe. We had Argentina. We had Venezuela in 2015, 2016. We have Venezuela now. Israel in 1986. These things are symptomatic And what happens simply is that the authorities, whether we're talking about the government or the central bank, they are coerced to print money. They're coerced to provide liquidity to the market, else the whole economy could seize up. And then if there is a stock market in the nation, in socialist countries in the 1990s, when they were imploding, there was no stock market, so there was nothing to absorb the liquidity. But in economies that have a stock market, the stock market absorbs a great deal of this liquidity. Simply, what people do is they get money on their accounts, and because they perceive the value of the currency collapsing, they want to get rid of it, and so they invest it into productive assets, and so a lot of that money gets absorbed into the stock market, which is why you get a vertical ascent. And so I think that we're going to get that in Japan, we're going to get that in Britain, we're going to get that in Europe, and in the end, I think we're going to get that in the United States as well.
Yeah, so you mentioned the prospect of gold going all the way up to 5,000, 10,000, 20,000. What kind of world would that look like in your eyes? I've often heard the saying that, you buy gold, but you hope that it doesn't go up, because if it goes up, it means
you
not
have
too many
big
good
problems.
things happening. Yeah.
Yeah, exactly. Well, I think that we're up the creek with no paddle, and I mean that okay, so let me put it this way. I don't think this is your father's crisis, We everything we know about the markets, about investing, about the asset valuation, whatever you want, interest rates, we know on the basis of the last 20, 30 years, right? Even the people who are seniors, who are veterans at this, they've been around 30 years, 40 years, maybe, people like Jim Rogers, 50 years, So these are your standards to gauge what might happen. But we are at a moment where there's the whole Western world is in the world of trouble. And I think that we're coming to the end of a continuation that might stretch back 5 centuries. And now that whole system of governance, that whole economic and financial system is starting to unwind, because you have this geopolitical conflict between the West and pretty much the rest of humanity. You have, the alliance between Russia and China, and the BRICS nations. Many of them are becoming more and more committed to this multipolar integrations. And you have the Shanghai Cooperation Organization with a number of Eurasian powers on board. And as things are looking, this conflict is not going well for the West. And the Western system as it is not going to survive. The only way that the Western system could survive as it is if it shut itself off into a block, like an autarky, like a North Korea type regime that just blocks communications and trade and cultural exchange with the whole rest of the world. But that would be extremely bad for everybody. And so I hope that doesn't come to pass. Things are going to have to change radically. I think that we're going to have a new monetary system. The present one is a copy of a copy of a copy of a Bretton Woods system. It's unraveling. It doesn't work. This monetary system actually never worked. It's good at the start, because it creates this credit impulse, and for one business cycle, everybody feels prosperous and the economy really is developing and growing and we're building prosperity. But then when everybody is in debt up to their eyeballs and all the collateral has been tapped, you can't, there's no further money good collateral. You have to keep the credit impulse going. You just have to lower and lower and lower credit standards. And we've seen this happen on a smaller scale again and again and again with the, like 15 years ago with the global financial crisis, which was triggered by the real estate bubble, right? The system levels off, the growth engine starts to sputter, and then it starts to collapse like a house of cards. And then the only way to keep it going is you have to keep adding collateral into the juggernaut. And the only way that you can do that is by taking it from other people, which is why this system also has the side effect is that it goes into the state of permanent war, because you're constantly at war with other people who don't want you to have their collateral, so you have to take it by force. But now the Western military machine is no longer capable of delivering this. We saw that the US and NATO troops had to withdraw from Afghanistan. They had to concede defeat to the Taliban. Today we see that the United States, after 9 or 10 months of the big Operation Prosperity Guardian, cannot stop the Houthis from disrupting the traffic through the Red Sea. Western powers can no longer defend their hegemony in the Middle East. They can no longer defend Israel. And so the fear factor is no longer there. So there's no easy way to coerce other nations to toe the line of the empire. And history also tells us that every single empire in the past ultimately collapsed. And so I think that we are now at the point where things are starting to unravel in a way that we haven't known and we haven't seen in centuries. And so we really are in uncharted waters. So predicting what might happen from here on, I think, is extremely difficult. But I would say that we should expect things to get probably worse than what the precedents of the recent past might suggest.
Yeah, because I believe, and I think you believe it as well, that we're in the midst of a power transfer from west to east. And in the process of doing so, it's going to be very messy. And we're in the messy part right now. But
I think, Danny, we're in the beginning of the messy part.
Yeah.
And how messy it might get, I don't know. But one thing that the thing that really, really intrigued me is the recent events in the United Kingdom. 29th July, we had the stabbing of 3 beautiful little girls by some crazed, Muslim immigrant. And then all of a sudden, there's all the social media is flooded.
He wasn't actually Muslim, by the way.
Oh yeah, you're right. But the initial, yeah, you're right. The initial accusations were that it was a Muslim immigrant. You're right. Yeah. And then all of a sudden you had all these riots everywhere and these supposed British patriots confronting these Muslim immigrants and fights breaking out and so forth. And then, as it turns out, a lot of this was contrived. I mean, something might have happened, but not very much, because a lot of people from the UK, even from the cities where these riots were reported from, said, like, I don't see any riots. Everything seems calm here, which made it appear that the government invented the whole story, or they hugely exaggerated with a view of implementing a major crackdown. And it occurred to me later to think, like, why now? Because, like these stabbings, they're not new in the UK. Knife crime has shot off years ago. The problem, people's resentment against immigrants is not new either. And so I was wondering, why now? Why is the government so keen on cracking down? And then I kind of looked into what's been happening at the end of July and the beginning of August that might be related. And, my suspicion was that they want to crack down because something bad is going to happen in the financial markets. Maybe there's going to be a bank failure. And in Britain, I think something like 90% of all bank deposits are in the big five banks. Like their banking system is not very robust. It's not like you have thousands of small banks. It's really all largely concentrated in these big, HSBC and NatWest and these behemoth global systemically important banks. And so if one of them crashes, if one of them collapses, then they all do. Then you get like a sudden collapse of the whole financial system. You have the mother of all financial crises. And it seems to me that Britain brought itself to this position because they went in over their head in the whole Ukraine misadventure. And sure enough, as I looked into it a little bit, there's been a flurry of activity between the British government and the Ukrainians and the private bondholders. And Ukraine owes the Western sponsors about $160 billion. And of that, about $20 billion is owed to private bondholders. People like BlackRock and Amundi and another few of these large companies. And because, Ukraine's economy is practically collapsed, it's lost at least 25% of the GDP since the war started, they cannot service those debts. So 2 years ago, in July 22, these private bondholders agreed to freeze the debt servicing payments from Ukraine to the bondholders. But that expired when? 1st of August, 2024.
I see.
So they were extremely keen for Ukraine to start servicing at least the interest on this debt, which apparently amounts to something like $500 million a year. So we're not talking massive amounts of money, but apparently even this is a huge problem for Ukraine. And so there was a deal brokered on 22nd July between an ad hoc committee of these bondholders and the government of Ukraine. Ukrainians were asking for a 65% haircut for investors, so 65% debt forgiveness. The bondholders were offering 22. In the end, they agreed to a 37% haircut, but Ukraine was supposed to restart servicing the interest. But this agreement is like an agreement in principle. The bondholders themselves were supposed to agree to it. Well, a couple of days after this, Zelensky on the 31st July, Zelensky signed a decree which was approved by Ukrainian parliament, enabling Ukrainian government to suspend all external debt payments for a period of 2 or maybe 3 months. And so all these events, and okay, not to mention, Zelensky was in London on the 18th and 19th July. He had a meeting with Keir Starmer. He had a meeting with representatives of 40 European governments and Britain, King Charles. He had a meeting with BlackRock and JP Morgan and another few representatives of big capital that's backing Ukraine. And then you had, in the UK, you had these stabbings, and then you had these riots, and then you had massive government crackdown against protest, against free speech, and so forth. Basically, introducing an Orwellian authoritarian tyranny in the UK. And then Ukraine made a Kursk incursion, which I think started on the 4th August or 6th August, I forget. And then on the back of that Kursk incursion, the EU quickly approved a $4.2 billion financial aid for Ukraine. This was not invented then and there. This payment was due anyhow under this Ukraine facility program. But I think it sped up the approval and the transfer of the money straight away, because it seems to me that Ukraine is financially on the verge of imploding. And if that happens, it will drag the United Kingdom down with it. So we talked about $20 billion worth of private capital, which is on the hook. But there's another $140 billion. And some of it comes from the IMF, and some of it comes from the EU, and some of it comes from the US, and some of it comes from the World Bank. And as it turns out, multiple tranches of the World Bank loans to Ukraine were guaranteed by the UK. So I don't know how much they're on the hook for. I don't know what the effect of Ukraine's default will be. Default it will. But I think that, it could be one of those things like the subprime, where, you had one institution go down, and then everything just kind of started coming down like a house of cards. I think that they have now bought themselves 2 months with this emergency loan and with the not emergency loan, but this payment from the EU. But I think that we are maybe weeks away from a very, very significant financial crisis that might start in Great Britain, and might be limited to Great Britain and the the EU. But I don't know what the effects are going to be, but it could be something like the global financial crisis in 2008. We'll find out. I think it's potentially one of the big tradable themes for the rest of this year. And if it comes to pass, we'll see the Bank of England and the ECB, and this is already happening. Both the Bank of England and ECB have announced major changes in how they approve capital credit for financial institutions. The ECB announced massive short-term and long-term repos, and Bank of England announced something completely new and radical called the demand. I don't remember the word, but like demand-led system of managing reserves, which in effect means that they will accept any toxic sludge as good collateral and give pound on a pound credit for it to the financial institutions, which is what we started talking about, massive open-ended QE, which will lead to accelerating inflation. So I think if that comes to pass, what we're going to see is we're going to see a collapse of the gilt of the British sovereign debt. We're going to see collapse of the British pound, and we're probably going to see nominal rise in the British stock market, the FTSE. Nominal meaning, in pounds. So if you go long the FTSE, you definitely want to hedge your pound exposure. So that would be that theme.
Fascinating stuff, Alex. Wow. So we could potentially be weeks away from a debt collapse in Ukraine,
Yeah,
and that could spread as a contagion over to the UK and potentially even the EU. And who knows, maybe it can spread even further.
yes, I think that the first one first ones in the line of fire are Great Britain and the European Union. But then, Japan also has guaranteed some of the World Bank loans to Ukraine, and who knows what else they invested in. I think that exposure to Ukraine is going to bring down a lot of financial institutions and a lot of national economies around the West.
Well, here's more fuel to the fire to your theory there. UK and I believe it was Sweden or some European country, a number of European countries have actually started taking precautionary steps against monkeypox.
Yes. Yeah, that also
So
happened in the
right on,
same,
I mean,
right on
similar to how
cue.
we had
Exactly.
a repo crisis back in 2019, and then we had
Yes.
COVID right after.
Yes.
From that could be from that same playbook.
Yeah, yeah. And in fact, some of the announcements in the British media were that, this crackdown and these restrictions would only be enhanced due to the mpox pandemic. So yes, it's all very, very suspect. And unfortunately, we have to kind of scratch the surface and look into the dark places, and then we have to connect the dots, because last thing they will do, the very, very last thing they will do is tell us the truth about the state of things. Because part of the game is confidence. For as long as people have confidence in the economy and the financial system, then nothing happens. But when people get the wind that things are bad, then you start to get the reaction from the person on the street, from pension fund managers, hedge fund managers, ordinary investors, and then you get a stampede, you get a panic. And so we'll find out, but I think that the situation is rife, and something is going to happen between today and the end of this year, and I would be keeping my eyes on London.
I see. Well, Alex, I wish we had some more time, but it looks like we're about to wrap up soon. Anything else you want to talk about before we close things out?
Well, this is kind of obsessing me at the moment, and I've only gone through the research for the time being, but I will, I will put together something a bit more structured and more articulate over the coming day or two on my Substack. Anything else, I think that we are in that 500 years transition. The world is going to be very, very different. And for everybody and anybody out there, far and away, the most important thing you can do to protect yourself through the crisis is to reach out to your neighbors, get to know them, create a local support network. Because, yeah, you need to own some gold and some silver, and you need to lower your fixed costs, and all of those strategies. All of that is good and advisable and important, but I think that nothing goes as far as simply knowing who your neighbors are, knowing who you can rely on, knowing what you can do for your community, because you might need somebody to help you fix your car, fix your roof. Somebody else might need you to help them fix their internet and their PCs, or you might need a dentist who will fix your teeth in exchange for a dozen eggs, things like this. So, that's the important thing to do. And I think that is important to keep in mind because we're sailing into a big storm. We don't know how long it's going to last. I think we're all going to be fine. Well, most of us are going to be fine, but it's going to be rough sailing. It's going to be disorienting for a little while. And we're going to have to be learning new things, new skills, new strategies of moving forward. And we need to just be prepared, as they say, hope for the best and prepare for the worst.
Yep. Yep. Totally. Chance favorites are prepared. Where can people find you, Alex?
Well, I'm active on X. My handle is @NakedHedgy. I write a Substack. My Substack is called Alex Krainer's Trend Compass. And they can also find me on iSystem Trend Following, which is my website, my professional website.
All right. Well, we'll have all those links down below. So, guys, be sure to check them out. And also be sure to hit the like button, hit the subscribe button if you haven't already. And comment down below. Let me know what you think. What's your take on all this, guys? This is my first time coming across all this information in relation to the Ukraine debt and how it ties into the UK. Let me know in the comments down below what you think about all this. I still am in the process of processing all this. So really interested to get your thoughts. And with that said, I will see you in the next episode. Bye, y'all.
All right. Thank you.